I want to go to some key VIX levels real quick for you, and I want to give you a homework assignment. And please realize the VIX levels for most people represent fear. For you, I want them to represent opportunity. So the VIX levels just really represent fear, and it's an indicator for when people are worried about where the market is going to be. Even if you don't know when to get in based on the price of the stock, even though I give them to you here on the show, if you mark off these levels, you'll know when you should start to look to get into the market. And before we get to these levels, you shouldn't panic. So if you know when to get in, because I'm telling you, and these levels, I think it will make your investing journey a hell of a lot easier. But let me guide you through them really quickly. So a really quick way when you go to the VIX is to mark off the top 5 highest prices that you see in the market. So of course, this is one, and then we have these 3 here that were hit. So 85, 47, and you can draw a range here. So let's say from 83 to 85. If the market got to these levels, this is 2020, that would be a place that you would look to buy. Second level would be, let's say, let me scoot this over for you. Let's say about $58.29. This would be another level here. Okay, and then let's say hypothetically, if we got to, and this is really interesting because here, here, and here, this price was hit 3 separate times. So if we look back here in 2015, 2018, early in 2020, this price of $49.41 had been hit 3 times. This is like a very key level that has been hit 3 times. This is what you would call a triple top. This has happened 3 times. And then of course in 2020, it broke through and went from that 49 level up to 85. So when you see these VIX levels, let's say you set an alert, and let's say you see that we get above this $49.41 level on the VIX, that would be a time that you will want to look to buy the S&P 500 or any stock if it's in the top 2 of its industry. And if it's in tech, healthcare, I want to be very careful because I don't want you to buy like marijuana company and then all of a sudden this strategy doesn't work. So like a top 3 sector and buy the top 2 companies in it. And if these prices push above, so let's say hypothetically, I think it will, but if next week, if we break above and go from 29.69 and we break above 49 and get to 60, this would be an area I would look to start to buy the stock market for the long term. Now, the most important lesson for you and homework assignment is I want you to go back over the last 20 years and figure out what are the top 5 highest prices the VIX has ever achieved. So if the market is ever, because a lot of times when the market takes a turn for the worst and people are surprised, it's only because they didn't prepare while the market was doing incredibly well. So if you have these prices marked off in advance, they won't scare you as much, and then you will start to have a certain level of excitement when it's at like a doomsday kind of level. So if I got an alert hypothetically on Zillow and it told me a house in, let's say Gary, Indiana, went on sale for $6,000, and normally that house is $35,000, to me that's a hell of a steal. These VIX levels really tell you the times that you should be staying and looking to buy in the market, and when they hit lows is times when the market is not at a level in which you should consider buying. Let me go back to the chart real quick so I can show this. So if you look down here, this is April of 2020. This is here June of 2020. We were constantly at like $14, $15 in the market down here across the board. When the VIX is this low, and the low of the last 5 years is 856, that is telling you that when volatility is low, that is the calm before the storm. Then you can see in 2020, we stayed low because of quantitative easing. And then once we had a little issue with Corona, which was the canary and the coal mine scenario, we shot up to 85 and then we slid back down. VIX came back down. Now we went back to these same lows again. And if I compare it to the S&P 500, let's look. So when the VIX was low, we had all this upward movement consistently, month over month. And then when the VIX starts to move to the upper side, the market then slides back down. So you don't ever have to guess. You don't have to worry about opinion or conjecture or spin. You really want to look at these two things. What is the price of the VIX? Number two, is it at a low? If it's at a low, that's when you have to start to get concerned about buying at a bad price. If the VIX is at a high or close towards a high, that's when you want to look to begin to buy high quality companies. And that's really the easiest 3-step system to be able to know when to buy in the marketplace. So when I meet a lot of you guys in public, and I can't wait to see you at Market Mondays Live in Madison Square, please go get your tickets. And in London, a lot of you are asking me, like, historically, what are you looking at? And this is going to be my last time saying it. Your best bet is to go look back 30 to 50 years on a stock, because you really get to study the history of an asset class. So if you look back here in 1987, this is the year my brother was born. This is the year that I tell you that Par Tudor Jones made all that money during the crash. The VIX got to $172.79. Trust me, the world was on fire, and everyone, this is like 100 times worse than what the market is like right now. If you look at all of these peaks, 1987, if we go to 1989, here is October of 97, 2001. And I know I've told you this before. From 99 to 2001, things were really tough. The attacks on 9/11, of course, sent the market spiraling, because it was spiraling before then. Then if we go to 2002, 1, 2, 3, 4, 5 times it hit this key level over and over again of $48.62, which is a little bit less than the area we called off earlier, 49 and some change. So this 48 to 49 area is a really key level in the VIX. Then we go to 2008, it shot up to $87, nowhere near where the price we were in 1987. But during all of these times, if you would have bought, and let's say you would have known to invest in the market every single year, in each of these dips, in each of these peaks in the VIX, you would have historically made money 100% of the time if you held for a 7-year period. It's not that complicated. But number one, you have to go study that 30-year period over and over and over again for every asset class that you are invested in. And then after that, you want to look and identify what the peak of the market is. And even for stocks, you need to go mark off homework assignment. The top 15 companies that you really love, go mark off every peak so you don't buy at those areas. How many of you would have been better off if you would have done your homework on whatever 5 or 10 companies and say, hey, once it gets 10% away from this high, I'm not touching it, I'm not looking at it. This is a secret that will help you forever. And honestly, for me, 5 or 6 years ago, I was sitting in the movie theater. I was going through Thinkorswim. When I did the same exact exercise, I marked off a certain amount of key levels in which it told me to buy, and it helped my trading tremendously, and when to buy long term. And I hope it does the same. And quick question for you. Why are you not reading every single report that the top 5 best hedge funds are putting out? I talked to Stock Club about this last week, but when AMC and GameStop was on fire, and the whole plan was for crypto to take over the banks, and AMC and GameStop would revolutionize retail investing, Barclays, they put out a strategy to elicit retail buyers to buy more, and the hedge fund would make money as the stock was going up and trading it on the way down. Goldman Sachs, Citadel, JP Morgan, Barclays, every quarterly report that they put out on what they're doing, you should read. Now, this is for my traders who really are in the weeds, really want to be great at this. If you are not familiar with the strategy that they are running, in this case it was a strategy, why are you not looking and seeing what your competitors are doing? Not only as a retail investor, and you may think, hey, I don't need to know that. I don't want to work for a hedge fund or trade for a prop firm. But if you know how, because in every trade, there's always a winner or loser, and there's always opponents that you have. So if I know hypothetically that in a zero interest rate environment, majority of all the big money in the world is going to be invested heavily in tech, it does help my two index strategy tremendously. And if I know when they stop buying, that will tell me also when to stop buying. For those you in particular that do options, it would help you probably get anywhere from 300 to 600% more return over a 2-year period if you knew what they were doing. I would argue to say, if you want to make any real money and truly have financial freedom, if you're trading and you do not know what strategies they are running, and I hate to say it, and it will always be true, the hedge funds and banks will always have more power than any retail traders just because they're putting more money into the system. You have to know how they're trading to be able to have an edge. But what an amazing feeling it is to know and also be able to work that into your system. Next year, we're going to talk about it a little bit more in Market Mondays. Definitely we are, but for sure, I want you to be able to trade at least 3 or 4 ways. You have to be able to make money whether the market is going down, whether it is going up, whether it is sideways, and especially when we have a bunch of volatility like we do now. Talks about it at InvestFest in Atlanta. You need to be able to trade 4 or 5 things at one time to be able to produce higher gains in a shorter period of time, and putting on multiple trades at one time also is a hedging strategy. So if you're long oil, short ES, NASDAQ, short bonds, maybe long natural gas. I went into this in more detail, Stock Club this past Tuesday, but please write down what are the 6 instruments or assets that you would trade in 2023 to be able to give you wins regardless of what the market does. The truth is you have to produce, especially for the men. Man, I don't care if the market is down. If the market is down for 5 years, what are you going to tell your family when it's time to pay bills? Baby, I can't pay the bills because the market's been down and now my trading strategy is effed up. Nope, it's not going to fly. It is not going to fly. In any market condition, if they're playing 2-3 zone, you got to learn how to shoot. If they're guarding you close, man, you better have some handle and be able to go by and finish. If they're sagging off you, tween, step back, boy, light their ass up. This is no different. Right now, are you and your trading strategy calibrated to be able to make 6 figures in a year, in a month, in a week, in a day, when you want to? If not, that's what you have to fix.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.